Hey there, fellow traders. Welcome back to another IronFX podcast, your go-to podcast for all things forex trading. I'm your host, Woon Hong, and today we are diving headfirst into a topic that's often debated in the trading world: higher time frames versus lower time frames. Which is better? So the first segment we'll be talking about the battle of the time frames. So just picture this: you're in the middle of a high-stakes trading session, alright? So the charts are moving like a roller coaster and you're sweating bullets. This is the world of lower time frames, where every tick and pip matter. But is this frenzy the right way to go? On the flip side, we have higher time frames: the daily, weekly, and monthly charts that move at a relatively slower pace. They're often seen as the realm of the patient and technical trader. But are they too slow for your taste? Segment 2, lower time frames, the fast and the furious. Let's start off with the adrenaline rush of lower time frames. They're like the fast lane on a trading highway. Think 1 minute, 5 minute, and even hourly charts. The action is intense and the potential for quick profits can be thrilling. Day traders and scalpers often flock to these time frames, capitalizing on short-term price movements. But here's the reality: they also face high stress levels and more significant risk. It's easy to fall into the trap of overtrading and also making impulsive decisions. Not to mention the known unknowns, which are your news events such as the US non-farm payroll news. This could cause pairs such as, for example, Euro USD, GBP USD, and gold especially, to fluctuate due to the high volatility. Segment 3, the slow and steady, which are your higher time frames. Now, let's shift gears to the higher time frames, where the pace is more leisurely. The daily, weekly, and monthly charts are the kingdom of swing traders and long-term investors. You have more time to think and plan, and is often less emotionally taxing. Patience is definitely a prerequisite as well, because it can take days, weeks, or even months to see the fruits of your labor, and not everyone has the discipline to wait that long. Segment 4, the balance, a fusion of both worlds. So, you may ask, what is the solution? The reality is that the best approach often lies in a fusion of both worlds. Mix high and low time frames strategically, right? Use higher time frames for overall market analysis and identifying long-term trends. Then switch to lower time frames for precise entry and exit points. For example, if you look at the daily time frame for your overall market structure and key levels, then drop down to the 4-hour time frame to look for potential entries. This combination can be the key to consistent and well-balanced trading. It is proven that many successful traders use this blended approach to harness the strengths of both lower and higher time frames. Segment 5, final thoughts and takeaways. Before we wrap up, let's summarize the key takeaways. For lower time frames, we have high risk, high reward, and fast-paced action. For higher time frames, we have lower risk, less stress, but slower profits. So, a fusion approach, a balanced mix for the best of both worlds. Lastly, you have to keep in mind that there is no one-size-fits-all answer. Your trading style, risk tolerance, and personality should guide your choice of time frames. And there you have it, traders. Higher time frames versus lower time frames, which is better? It's not about choosing one over the other, but finding the right balance for your unique trading journey. And lastly, if you enjoyed this episode, don't forget to tune in to our future podcast or past podcasts to learn more. We hope to help you every step of the way to become a better forex trader and to succeed in this journey of yours. And as always, trade wisely, Stay safe, and we'll catch you guys in the next episode.